A junior accountant at Lehman Brothers sits in a conference room on a Tuesday afternoon in May 2008. In front of him is a spreadsheet detailing a transaction labeled Repo 105. The numbers are staggering. $50 billion. That's not a rounding error. That's not a minor accounting adjustment. That's half the GDP of Slovenia temporarily vanishing from the balance sheet right before quarterly earnings are announced. The transaction is technically legal. The contracts are signed. The lawyers have reviewed them. But something is wrong in the fundamentals. The assets aren't actually sold. They're just moved off the books with a secret agreement to buy them back a few days later at a slightly higher price. It's a shell game with billions in stakes. He raises his hand and asks the question that will get him fired within days. Is this really accounting, or is this fraud? 4 months later, that unanswered question will echo through the greatest financial collapse since 1929. Lehman Brothers had been a fixture of American capitalism for 164 years. The firm had survived wars, depressions, and recessions. It had financed railroads, managed fortunes, and weathered every storm the markets could throw at it. By 2008, it was the fourth largest investment bank in the United States, with assets exceeding $600 billion. The firm occupied a gleaming headquarters on 7th Avenue in Manhattan. The trading floor was a cathedral of capitalism. Rows of desks where traders made billions moving money around the globe. The CEO was Dick Gould, a man known on Wall Street as the gorilla because of his aggressive, confrontational management style. Gould had spent 40 years at Lehman. He had built relationships with world leaders and had the ear of the Treasury Secretary. When Lehman spoke, markets listened. The firm was supposedly built on conservative risk management and solid fundamentals. This was the narrative that had been carefully constructed and maintained. The narrative was a lie. By 2007, the subprime mortgage crisis had begun to crack the facade. Banks across America were holding billions in mortgage-backed securities that were rapidly declining in value. The housing market was collapsing. Foreclosures were accelerating. The assets that had been valued at face value were now worth pennies on the dollar. Lehman Brothers had massive exposure to real estate markets. The firm had built a mortgage origination business called BCC Holdings that was hemorrhaging money. It had a real estate investment trust called Archstone that was becoming a liability. The balance sheet was deteriorating month by month. But the earnings reports kept showing the firm as profitable. The quarterly conference calls with investors kept projecting stability. The executives kept reassuring the public that Lehman had a fortress balance sheet and that everything would be fine. The mechanism that allowed them to maintain this fiction was called Repo 105. Repo is short for repurchase agreement. In the repo market, financial institutions essentially pawn their assets to raise quick cash. You sell a bond to another bank for, say, $95. You simultaneously agree to buy that same bond back in 3 days for $95.50. The 50 cents is the interest. It's supposed to be a short-term liquidity tool, not an accounting trick, but Lehman weaponized it. Under something called Repo 105, they would remove bonds from their balance sheet by selling them to a counterparty at the end of the quarter, right before the earnings reports were finalized. The bonds would be gone from the balance sheet, making the firm look lighter and less leveraged. The debt would disappear from the calculations. The leverage ratios would improve. Then a few days into the new quarter, after the earnings had been reported, Lehman would buy the bonds back, returning them to the balance sheet. The entire operation was a round trip designed to create an optical illusion of financial health. The genius of Repo 105 was that it was technically legal. The accounting rules of the time, called FAS 140, allowed for sales to be recorded as sales even when the seller had already agreed to buy the assets back. The key was that the repurchase price had to be higher than the original sale price. So legally it looked like a genuine sale, not a rearrangement of assets. Lehman exploited this ambiguity with ruthless precision. They would sell bonds for 105% of face value and agree to repurchase them for 105.5% a few days later. The math checked out. The lawyers signed off. The transactions were recorded as true sales, not as temporary movements of inventory. By the end of 2007, Lehman was using Repo 105 to remove approximately $15 billion from its balance sheet quarterly. By early 2008, that number had grown to $50 billion. $50 billion. Every quarter, the same sleight of hand. Every quarter, the balance sheet improving artificially. Every quarter, the investors told everything was fine. The CFO during this period was a woman named Erin Callan. She was promoted to the position in 2007 relatively quickly without the traditional background in accounting that CFOs typically had. She was articulate and media-savvy. She appeared on financial news shows and spoke about Lehman's strength with a confidence that seemed unshakable. She wore stylish clothes and had an air of authority that resonated with investors. When she said the balance sheet was strong, people believed her. She became the public face of Lehman's financial stability. What the public didn't see was the constant pressure to hit targets, to show growth, to demonstrate resilience in the face of market chaos. The earnings reports were the scorecards by which her performance was measured. If the quarterly numbers looked good, she was praised. If they looked bad, she faced intense scrutiny from the board and from Dick Fuld. The Repo 105 transactions gave her a tool to manage the narrative. When the real numbers looked weak, she could deploy Repo 105 and suddenly the numbers looked strong. It was intoxicating. It was also fundamentally dishonest. In May 2008, Matthew Lee, a senior vice president in the accounting and control function, became deeply concerned about Repo 105. Lee was a thoughtful, by-the-book kind of accountant. He had spent years at Lehman, building credibility as someone who understood both the technical details of accounting and the practical requirements of a trading business. He knew when lines were being crossed. He had reviewed the Repo 105 contracts, and he understood that they were essentially disguised debt. The bonds being sold were virtually certain to be repurchased. The risk of holding the bonds remained with Lehman. The gains or losses from the transactions were minimal. It was not a true sale. It was balance sheet manipulation. On May 16, 2008, Lee hand-delivered a letter to the office of the CFO. In the letter, he detailed his concerns about accounting improprieties involving billions of dollars. He spelled out the mechanics of Repo 105. He explained why the transactions didn't meet the requirements of proper accounting standards. He asked for a meeting to discuss how to address the issue. He also copied the general counsel, the controller, and other senior members of the accounting function. The letter was specific, detailed, and professional. It was also a declaration of war against the fiction that held the firm together. The response was swift and brutal. Instead of addressing the accounting concerns, management decided to address the whistleblower. Within 4 days of sending the letter, Matthew Lee was terminated from Lehman Brothers. The official reason was performance issues. In reality, he had become a liability because he was unwilling to simply sign off on the books. The message was clear. If you question the accounting, you're out. Lee's firing became a symbol of a deeper truth about Lehman Brothers in 2008. The firm had become so dependent on the fiction of financial health that anyone who threatened the fiction had to be removed. The accounting had to be maintained. The earnings had to look good. The leverage ratios had to stay within acceptable ranges. And if that required getting rid of people like Matthew Lee who actually wanted to maintain professional standards, then so be it. By summer 2008, the subprime crisis had metastasized into a full-scale financial panic. Bear Stearns had been acquired by JP Morgan Chase in March with government help. Washington Mutual was failing. The Credit Suisse and Morgan Stanley were both in distress. The financial system was contracting rapidly. Credit markets had seized up. Banks were refusing to lend to each other. The leverage that had worked so well on the way up was now crushing everyone on the way down. A 3% decline in asset values would eliminate Lehman's entire equity cushion. Lehman's leverage ratio was 31-1. It was perched on a knife's edge. The stock price, which had been trading above $60 a share, had plummeted to the single digits. A share of Lehman Brothers was now worth less than a Starbucks latte. Dick Fuld, in his executive office on the 31st floor, stared at the stock price quote and couldn't comprehend it. He kept making phone calls to the White House, to the Treasury Secretary, to anyone with power. He believed that Lehman was too important to fail. He believed that the government would step in and save the firm. He was waiting for a rescue that would never come. By September 2008, the clock was running out. The firm had been unable to raise capital. Credit lines were being withdrawn. The balance sheet was deteriorating faster than the PR machinery could hide it. On Friday, September 12, Dick Fuld received a call from Treasury Secretary Hank Paulson. Paulson was holding a meeting of the Federal Reserve Bank of New York on Sunday. The CEOs of the major investment banks were being summoned. They were being asked to come to a conference room and figure out a solution to the Lehman problem. Paulson had made it clear that there would be no government money. The Fed wasn't going to create a special lending facility for Lehman like it had for others. Wall Street was going to have to solve this on its own, or the bank was going to fail. On Sunday morning, September 14, the CEOs arrived at the New York Fed. Jamie Dimon of JP Morgan Chase, Lloyd Blankfein of Goldman Sachs, Robert Mack of Morgan Stanley. They filed into a conference room on the 33rd floor of the Federal Reserve Building. The air conditioning had broken down. The room was stifling and uncomfortable. The table was mahogany. The tension was thick enough to see. The meeting lasted all day Sunday and into the evening. The bankers went through Lehman's books. As they examined the assets more closely, they began to realize something terrifying. The assets that Lehman claimed to hold were not actually worth what the firm had said they were worth. The real estate holdings were valued on the balance sheet at prices that no longer matched market reality. The mortgage-backed securities were toxic. The leverage was even worse than publicly disclosed. There was a hole in the balance sheet, and it was enormous. When they tried to model out what a solvent Lehman would look like after writing down the bad assets to realistic values, they arrived at a number that seemed impossible. Lehman would need somewhere between $40 and $60 billion in capital. No single bank could write that check. No group of banks was willing to do it. By Sunday evening, it was clear to everyone in the room that Lehman Brothers could not be saved by Wall Street. The only option was a government rescue or bankruptcy. Paulson made the decision around 11 p.m. on Sunday night. There would be no government money. The Federal Reserve, the Treasury, and the Oval Office had decided that Lehman was not systemically important enough to warrant a rescue. In retrospect, this would prove to be one of the most consequential decisions made during the financial crisis. But in that moment, it meant that Lehman Brothers was going to fail. The firm was not bankrupt yet, but it was terminal. Dimon walked out of the conference room and back to his car. Goldman Sachs's operations people started unwinding their exposure to Lehman. Morgan Stanley's executives began hedging against a Lehman collapse. JP Morgan cancelled the credit lines it had extended to Lehman. By Monday morning, the death sentence had been carried out, and the body just hadn't figured out it was dead yet. On Monday, September 15, 2008, Lehman Brothers filed for bankruptcy protection. The bankruptcy petition was the largest in American history. The firm had over $600 billion in assets and hundreds of thousands of counterparties. The filing triggered a chain reaction of events that would send shockwaves through the global financial system. The stock, which had closed on Friday at around $3.65 a share, was halted from trading. The value of Lehman's equity evaporated overnight. Employees who had held stock options and restricted stock units, expecting them to be worth something, discovered that they now owned a piece of a bankrupt company. The value was zero. On Wall Street, the old rule was that investment banks might fail, but they wouldn't fail catastrophically. They had been around for 100 years or more. They had survived depressions. They had weathered wars. But Lehman Brothers was the first major investment bank to actually fail in the modern financial era. The bankruptcy triggered a panic. If Lehman could fail, then everyone was vulnerable. No bank was safe. The credit markets, already fragile, seized up completely. The Dow Jones dropped 504 points on Monday, September 15. It was the single largest point drop since the day after the 9/11 terrorist attacks. 7 years earlier, Lehman Brothers had been displaced from its original headquarters by the towers collapsing. The firm had rebuilt and moved to a new building. Now, 7 years later, the firm was destroyed by the collapse of a different kind of collapse of confidence in the financial system itself. That week, the broader markets crashed. The S&P 500 fell nearly 20%. Global stock markets tumbled. Credit spreads blew out. Banks around the world were freezing access to credit because no one knew which bank was next. The interconnectedness of the global financial system meant that Lehman's failure rippled outward instantly. Money market funds broke the buck. Insurance companies were unable to access credit. Car manufacturers couldn't get financing for their inventories. Small businesses couldn't get working capital loans. The entire system was seizing up. The irony was that all of this had been avoidable. The Repo 105 transactions that had masked Lehman's true financial condition for years hadn't actually solved any of the underlying problems. They had just delayed the reckoning. The mortgage-backed securities were still toxic. The real estate holdings were still overvalued. The leverage was still unsustainable. The Repo 105 magic trick had bought time, but it had also allowed the situation to deteriorate further. If the true financial condition of Lehman had been disclosed to the market earlier, if the balance sheet had been accurate, investors would have had time to adjust. Banks would have had time to adjust. the market would have had time to accommodate a Lehman failure in a more orderly fashion. Instead, Lehman's dissection had obscured the problem until it was too late. The failure, when it finally came, was sudden and catastrophic. The investigation into what had happened at Lehman was conducted by an examiner appointed by the bankruptcy court. His name was Anton Valukas. Valukas was a highly respected attorney who had worked on complex financial cases before. He was given access to Lehman's books, emails, and documents. His team worked for years, eventually producing a 2,200-page report detailing exactly how Lehman had hidden its true financial condition. The Valukas report explicitly identified Repo 105 as the tool used to manipulate the balance sheet. The report included emails from senior management discussing Repo 105 as a way to manage the balance sheet and to hide the leverage. The smoking gun was there in black and white. Senior executives at Lehman Brothers had known that the accounting was improper. They had used Repo 105 deliberately to make the balance sheet look better than it was. They had lied to investors, regulators, and the public about the firm's true financial condition. The question of whether anyone would face criminal charges for this fraud became a major issue in the aftermath of the collapse. The Securities and Exchange Commission investigated. Federal prosecutors looked at the case. Ultimately, the government decided not to prosecute anyone for the Repo 105 fraud. The official reason given was that proving criminal intent would be difficult. The accounting rules at the time were technically ambiguous. A good lawyer could argue that Repo 105 was within the letter of the law, even if it violated the spirit of it. The burden of proof in a criminal case is beyond a reasonable doubt. The government decided that this was too high a bar given the ambiguity in the accounting standards. So, Aaron Callan, who had been the CFO and the public face of Lehman's financial stability, was not prosecuted. Dick Fuld, the CEO, was not prosecuted for fraud, though he was sued civilly. No one served prison time for the Lehman fraud. The firm was bankrupt. The investors had lost billions. The employees had lost their jobs and their retirement savings, but the people responsible for the deception faced no criminal consequences. The financial losses from the Lehman collapse were staggering. Lehman's bankruptcy estate included over $600 billion in assets. Many of those assets had to be liquidated quickly in a terrible market. Counterparties who had extended credit to Lehman lost billions. Investors who owned bonds issued by Lehman lost hundreds of billions. Employees who had deferred compensation and stock holdings lost the vast majority of their savings. The ripple effects extended far beyond Lehman's direct creditors. The financial panic that followed the Lehman collapse nearly destroyed the entire global banking system. The government had to inject trillions of dollars in liquidity and capital into the banking sector. Unemployment in the United States climbed above 10%. Millions of people lost their homes to foreclosure. The Great Recession, as it came to be called, destroyed trillions in global wealth and caused immeasurable human suffering. All of it traced back to a simple choice made by senior management at Lehman Brothers. They chose to hide the truth about their balance sheet rather than acknowledge the deteriorating condition and take steps to address it. They chose to deploy Repo 105 to create an optical illusion rather than to reduce leverage and improve the quality of the firm's assets. They chose to fire Macu Lee rather than listen to a voice saying the emperor had no clothes. Those choices had consequences. Lehman Brothers ceased to exist. The global financial system nearly collapsed. Millions of people were harmed. The incident revealed something brutal about how financial systems function. The incentives are misaligned. The person who raises his hand and says something is wrong gets fired. The person who goes along with the fraud gets promoted and gets richer. The firm that hides its true condition the longest has an advantage over the firm that discloses honestly. The market rewards deception and punishes truth-telling. The lesson of Lehman is not just about bad accounting or bad management. It's about the structural vulnerability of complex financial systems that rely on confidence. Once that confidence breaks, the system collapses with terrifying speed. Lehman was a 164-year-old firm. It had survived wars and depressions, but in September 2008 it was gone in days. The entire value that had been built up over more than a century was erased in a matter of hours once the market understood that the financial statements couldn't be trusted. The Repo 105 transactions haven't changed the underlying reality. They had just postponed the reckoning. When the reckoning came, it was not just Lehman that paid the price. The entire world economy paid the price. The question of whether the structures and incentives that led to Lehman have actually been fixed is still being debated 15 years later. The rules have changed. The regulations are stricter. the oversight is more intense. But the fundamental fact remains: when the reward for hiding the truth is greater than the reward for telling it, people will hide the truth. And when they do, the systems they participate in become increasingly fragile.